I'll look into that. But by the way, it's an easy transition into Jedi options right now. And it is our weekly segment we do on Wednesdays here with Coach Tyler, where he gets to kind of geek out in the options market. He finds either one pick or a couple of picks. He's done it several different ways. He dives into the analysis as to why he likes them. Usually there's a theme behind them, technical pattern, whatever it might be. Then he looks at different ways he can play it in the options market, either through strategies or volatilities, considerations, those type of things. Tyler, what you got for us today, man?
All right, so I pitched a couple of different angles for today. Could have done something, just so you guys know where my head was at. Could have done something in energy, but per our commentary today, a little early, right? A little bit early. That'll probably firm up and maybe give us a better opportunity down the road. So instead of trying to buy weakness, we went with not chasing strength, but rewarding strength and focusing on what's strong. And today, I don't know that this is a sector or industry that I have focused on in Jedi options. So a little change of venue, which is nice. Home builders are perking up today. In fact, I'm just curious, up 1.73%. If I look at my liquid ETF list, got the most actively traded ETFs in the market, and I sort by percent change, XHB is almost the top performer. So there's the reason why my eyes were attracted to this. I mean, look, home builders have been hot. Real estate has been hot. We're in the epic part of, I don't know what you want to call it, a super cycle maybe, but real estate's been nuts everywhere. I think that just has increased the sentiment, the optimism around home building stocks, to say nothing of the fact that technically they've been in fuego. We had a correction, a deeper correction in home builders, which was deserved and probably overdue. And so what you do in situations like that is you say, okay, look, I'm interested. The weekly chart in this thing, and come on, this thing went from 24 to 80 in a year. Had a weekly retracement to the 20. So you're interested, you're just waiting for a reason to participate. And I think you've got your reason right now. Oftentimes, I think I've heard you guys talk about this, you will see a failed bear pattern emerge that kind of spells the bottom for a
bear stop out day is what old Coach Frank calls it.
Old Coach Frank. Okay. So it took me a second. I'm like, Old Coach Frank.
Coach Frank.
Old Coach Frank. Got it. So check it. So this, you could argue, you had a big breakdown, heavy volume, bounce fails, right? Bounce fails. You get some heavy volume down days. Not a good look. Rallies again, go back a week. You're like, look, I'm not that interested here. Looks like it could be another failed bounce. Yesterday, these things get whacked. Kind of the same thing we said about industrials and financials and small caps, right? Get whacked yesterday, not a good look. And today, right back up, bullish reversal, bullish engulfing candle. And bear stop out day basically means anybody who shorted this bad boy, who sold the rally, does not want this to get above 74, 75 bucks, because that will arguably stop out a bunch of bears. Could give you some fuel to the upside.
What a question, Ty. The bullish engulfing technical pattern is one of the stronger technical patterns in candlestick patterns, right? Yep. Where the preceding candle is the body of the preceding candle is completely engulfed by the following candle, correct? Mm-hmm. We got to figure out a new name, though, when you see an increasing volatility bearish candle and then the bulls just say no. Like, not every bullish engulfing is created equal. A lot of them are doji followed by an increasing volatility on the bull. You had a big time sell-off yesterday, and it completely got gobbled up today.
Yep.
That shows me a little bit more additional strength than what a typical bullish engulfing candle would do. Just given the context to yesterday, you know what I mean?
Yeah. I feel like it needs to be something with some snark,
Yeah, no, absolutely. Like you thought you had something, but yet you met a bigger dog, bro.
Yeah, so right? You guys
There's
think
a bigger
on
boy
that.
out there.
Yes.
Right.
So Tim, you're the wordsmith here. You think on that for a minute. You give me a good couple of options, and then Matt and I'll decide what's
For the new bullish engulfing candle after a bear day like that, let me think through it. Okay.
Listen,
Increasing
I'm gonna call up
bearish
Steve Nissen.
volatility.
I'm gonna call up Steve Nissen and be like, Stevie, we got another.
Dude,
that wouldn't be good.
It's
That
a
would be
trank
good for
shot.
anybody.
It's a
The
trank
trank shot.
Yeah, you tranquilized the bear. The bear was getting all enraged. He was getting excited, and you like had to
The trank shot.
Trank shot at him.
Okay.
Put him
You
to
got
sleep.
trank shot.
Yeah.
Trank shot's good. That's
Okay,
good.
so the trank shot engulfing. I'll think about that one.
Let me think through a couple of options for you here.
Give him a minute, Matt. Give him a minute.
Yeah, okay, we'll give you a minute on that.
Okay. So
I see what you did there, though.
Maybe too clever on that one, Timmy. Walk it back a little. Walk it back.
Hey, you put me on the spot.
You got a minute. Let me pitch the trade. So I like this would be a potential reversal. And quite honestly, I mean, you can spin this any way you want. You can say, how about left shoulder, head, right shoulder, got a little higher pivot low, neckline breakout. Yeah, sure. I mean, however you want to spin this, the point is, like the breakout, like the space, gives us a reason to look bullish at Homebuilders. Now, if I want to play the whole industry, I just play XHB. That's the nice thing about the ETF. It's a diversified bet. I don't have to worry about earnings. And the liquidity ain't half bad on the options. You know, nickel bid-ask spread. Nickel bid-ask spread. I like it. Plenty of open interest. I say plenty. I mean, good enough. How about that? Love to see it in the thousands. Not super duper liquid, but liquid enough to play.
DH Horton has a very similar technical pattern to the actual sector itself too. It's an alternative to the ETF. I prefer the ETF. Just wanted to throw that out there. Yep. I know where you're going, and I like the one where you're going a heck of a lot more. But
and I will give you another. As Matt knows, I'll give you a contrast to this one if you want to play an individual stock. This I think would be a little bit more conservative play. So
I agree.
So from a strategy perspective, how do I want to build a trade around here? You can do lots of stuff. Options give us options, as we know. The implied volatility, neither here nor there. Not particularly high, not particularly low. When I get in a situation like this, vol is just not a consideration then, right? That's not going to sway me one way or the other. I'm going to focus more on which strategy I think better fits my technical outlook, and maybe which strategy I have a preference towards, I have a bias towards. So I think in a situation like this, I'm going to go with more of a mildly bullish play, a little bit higher probability, like +1 would be my directional bias based on our spectrum that we teach. I'm going to do a diagonal spread. You can call it a poor boys covered call. All I'm going to do here, you know what I was thinking? Do I want to go out to December, January, go longer term? I'm like, yeah, I start with the best of intentions doing that with maybe, okay, I'm going to sell multiple months against it. But then the stock chart gets all wonky and I bought all this time I didn't end up needing. So the more I think about this, I just want to buy a 2-month in the money call. So I don't want to buy the stock. Okay. I want to buy a 2-month in the money call kind of as a stock proxy. Give me a 70 strike, you know, you get higher open interest around those whole numbers. So I'll take a 70 strike, 71 delta, paying $5.70 at the midpoint. And let me sell. Now you could say, okay, do you want to do the August monthly? Do you want to do a 30-day? I ain't messing with the weeklies unless they're super liquid. And that ain't the case on XHB. So I'm going to go with the AUG and I'm going to sell maybe a 30 delta. I'm going to sell a 30 delta, be the same as what I would probably do with a covered call, pick up $1. It's going to reduce my cost by almost 20%. So I'm going to control click, sell the AUG 77 strike. So I got a SEP 70, AUG 77, $4.68. You say, I don't know what that is at the top of my head. I can't picture it. Well, go look at the risk graph and you'll see what I'm talking about here. It should, if properly structured, look like a covered call, right? But I didn't have to pay too much for it. Paid $4.68. I like the shape. Okay, if this thing gets to 77, max profit. You look at the blue number down here. We're talking $240. It's over a 50% return. Which is plenty. And all I need is this thing to head towards 77, which I think is completely realistic. If this breakout sticks, 77, you could certainly get there in 44.
What happens in a trade like this, Ty, where you're doing a diagonal spread? You obviously have a bullish stance on it. What happens to the trade? What happens to a diagonal spread if we see sideways action in the home builders over the next 3-4 weeks?
So this is where you have a choice, because you can structure these where you do get a profit if we go sideways.
Mm-hmm.
If you do that, I didn't do that. So in this case, if you look at the graph, risk graphs are probably the most important tool with a diagonal spread. You can get away without a risk graph on a lot of option trades. This is one where you can't really do without, because you don't know exactly what your profit range looks like. So my break even, Matt, is at the current price. So I'm really not going to generate much of a profit if we go sideways. It's just a scratch. It's break even, right? If now it doesn't have to be. It doesn't have to be. I could structure this so that I'd still have a profit if we go sideways.
But based on the fact that you're buying the 70 and selling the 77, the way you have structured it, you basically net neutral on sideways.
I'm neutral sideways, and it's got to go up for me to make some dough.
Yep. Which is the slightly bullish bias, right?
Which is the positive one, right?
Mitigated risk to the downside. Neutralities sideways equals basically break even. Upward drift equals profitability.
Yes.
Yes.
All you would have to do if you wanted to make this profitable if we went sideways is don't sell as far out of the money on the short.
Sell the 75.
Sell the 76, sell the 75, do something. And quite frankly, play with it. I mean, look, this is the beauty of having the tool is you can say, what if I sold the 76 strike? Okay, now I make 48 bucks if we go nowhere. Okay, there you go. Maybe I sell the 75. Okay, now I make 85 bucks if we go nowhere. And I still like the potential profit if we go up. You know, maybe you like that.
But you've also, by making a little bit of money, there's always a give and take here, right? And that's why that's what you're doing when you're playing around with the risk graph. And that's what option traders love doing is just clicking buttons on a risk graph until they find something that looks good for them.
Yep.
But what you're doing is you're giving up some of your profitability to the upside for a little bit of profitability and neutrality. And that's the give and take we make as traders.
And reducing cost, by the way.
Yeah. And cost reduction.
Mm-hmm.
Yep. Yeah. So there is always a trade-off between the probability of making money and the amount of money you actually make. It's just eternal. It's always that way. And in doing this, in widening the profit range and lowering the break even, which means I make money if it goes sideways. There you go, buddy. Right? Which means I have a higher probability of profit.
Keep going.
Which means I can't make as much money, right? Like what do you want? So any one of these works. Any one of these, buy the 70, sell the 75, 76, 77. I like all three of them. It's just a matter of preference.
Mm-hmm.
Yeah. So that to me would be like cash flow play, a little bit more conservative. If I want to lean bullish off of this, what do we call it? Off of this trank shot engulfing candle here.
Well, Jeremy Johnson out there, Team Tackle, likes the idea of an engulfing bear slayer candle as well. So if we're
bear slayer,
the bear
slayer. Give me a second, Jeremy. That might. I need that one to soak a little.
Soak it up.
But does bear slayer roll off the tongue as well as trank shot engulfing?
It's a trank shot engulfing.
That is why he makes the big bucks.
All right, can I give you my second one while you
let's see it. I do have a question about the weeklies at some point, but so when you said the weeklies were illiquid, because if it was me, I'm building the September, I kind of would prefer like a 30-day option. I have no problem with August. Just wanted you to clarify what you saw in the weeklies that made you decide to stick with August.
Okay, well, so this is where experience comes into play, right? We call this inference. Inference, Timmy, that's your word of the day, okay? I inferred, because I looked at the monthly options, and I see a lot of strikes that have less than 100 contracts, right? The at the money had 543, which was great because it was a whole number in at the money. Okay, because I knew the liquidity was okay on the monthly, but not fantastic, I inferred that the weeklies are not going to be as good because they're never as good, right? On the liquidity scale, monthly's always on the top, weekly's beneath, right? So I didn't even look at them. because I'm pretty confident they ain't going to look that great. If I wanted to confirm that, I would have opened up the 30-day. I would have looked at the open interest and said, in fact, I was right. There isn't much there. So that translates into wider bid-ask spreads. Now, is it immediately a deal breaker? Yeah, maybe not. I mean, if you're okay with playing with zero open interest because you anticipate the open interest will grow as this gets closer to expiration.
Well, and just a quick point on that, it will grow as it gets closer to expiration because these weekly options have simply not been as available as the monthly options. And so it will increase the liquidity. So typically speaking, the inference of weekly options being less liquid is absolutely correct. But something that is traditionally liquid from a tradable instrument, weeklies will be fine.
And you're kind of seeing that in the bid-ask spread, right? They didn't start out with $1 by $2.
No,
it's $1.65,
exactly.
$1.75. So I think the tighter bid-ask spread would give me the go-ahead if I wanted to do it. And you could compare it to the week that has 2 days left that's been around for a month and say, oh, well, this guy had open interest accumulate, and it getting ready to go out, maintain a bid-ask spread of 10, 15 cents. Okay, I mean, this is the future of this 30-day option.
Right? You know what you're playing with.
Yep. So Tim, you could do it if you wanted to.
No, I appreciate you going in. And
look, just don't call me up when you put in your order and you're at the midpoint and you're sitting there twiddling your thumbs like, hey, I ain't getting filled, man. I ain't getting filled. That's just, you might have to navigate the bid-ask spread and adjust the order a few more times. But
gotcha.
You could do it.
When in doubt, play the monthlies.
Yeah. Okay. So what's our second play?
Okay, so the second play is to pick an individual stock in XHB. You sure as heck ain't going to pick another home building ETF. Why? This is the best one. This is the most liquid. You're not going to go with something else. It's redundant. So instead, maybe you drill into the constituents, the holdings of XHB, see if you can find something nice. And I did that. I looked at Pulte, I looked at KB Homes, DHI, and we liked Lennar. LEN, I think, was the most mature reversal, the best looking reversal. Just compare it in your mind's eye to what I showed you on XHB. XHB was below the 50-day moving average, just trying to break out. This thing broke out a week ago, a little two-step pullback, and is popping again today with a nice little bullish engulfing itself. So leader in the space, right? We reward strength. We like leaders. We like those that have relative strength. So this to me is a better pick than, say, bottom fishing on KB Homes, which doesn't look as good as the sector, right? So LEN, I think, a top pick of the individual holdings because of the strength and because I want to have some contrast here. Not going to do another poor boys cover call or diagonal. I'm going to go with a bull call vertical spread. Simply going to shoot for this to go to 110 as the target. I think that's pretty clean. I mean, you could probably say it's triggering right now. You could have a little more confirmation if you want, but I like where it's at as the trigger. I like yesterday's low, maybe, or even $100 as potential stop areas. So I can map out a low risk, high reward potential trade setup here, which is part of the appeal. Then it's just a matter of, again, how do I want to play it? So long calls, that'd be a +3 trade, make a lot of money if you're right, but you're requiring the stock to move a decent amount. I like more the bull call, which is like a moderately bullish, increases my odds a little bit, but still gives me a decent payout. So normally I like to buy around an at the money call and in this case, sell the 110. I'm not sure if it has a 102 strike. So could buy the 105, sell the 110, but let's see what we got available here. I kind of wish we had September options because now my choice is go 3 months out. Hey, I don't know the months. What month? August, September, October, November. 4 months. Go 4 months out or do 6 weeks. 4-month trades are just slow for me. So November would be a little bit rough for me. I think I have to do August on this guy, get the resolution a little quicker. And indeed, I don't have a 102 strike. So I'm either buying the 100 and selling the 110, or I'm buying the 105 and selling the 110. I don't have a strong preference between the two. Your break even is going to be similar. Your probability is going to be similar. The difference is the cost. So if you want a cheaper trade, buy the 105, sell the 110. If you want something a little bit more juicy, buy the 100, sell the 110. Let's see. So you're paying $4 for a $10 spread, or $1.60 for the $5. I'd probably do the $1.60 for the $5 spread.
There's a debate there. There's a discussion, because the $4, you're anchored in the money by 260 on that one strike, right?
You are.
So you're getting some intrinsic value on the one that you're buying. Your theta rate's probably going to be better than that. If you go the out of the money purely, you're going to have a negative theta. So it would be literally something an option trader would look at and have to determine, how aggressive am I and how comfortable am I increasing my cost a little bit to get intrinsic value, right?
I think with doing the 44-day option, I do lean to the 100 by 110. I think you take the delta difference on it.
I think that's a good call.
You're being aggressive with the time frame that you're selecting.
Right.
I think you got to get some delta to take advantage of that.
Yeah, and keep that theta rate low. Yeah.
Well, I would agree with that. Yeah.
Well, and you're also mitigating theta by selling something against it. So working in the 44-day contract shouldn't have that big of theta issue over the next couple weeks. I wouldn't be worried about that. I just think you got to try. I mean, if you do the 110 by 105, man, you're what, 17 delta?
Yeah.
Yeah. So your delta is about 35. You're probably half. Yeah.
Yeah, and so I think the 61 by 26, it's a little aggressive, but I think that's kind of where you're leaning.
And your ROI is pretty good too. You got a better break even 104 versus 106.60. So
I wouldn't fault anybody for the 105, 110. I don't think that, I think it's a discussion.
It would be easier if it was September, October though, and gave you a little more time. So yeah.
Yeah, September makes everything a little easier. Come on, market maker, get your act together.
Yeah, give us some choices.
It's time.
All right.
All right, so then settling on that then. So we'll go AUG 100, 110. That'll be the second one versus the XHB Poor Boy.
Well, and even at $4 on a $10 spread, that's within basic rules. You don't want to go more than 40% pretty much of the spread distance. So, all right, a couple of interesting ones here. We've got XHB as the entire home builder ETF, using September, August, 70 or 75, 76, 77, depending on whether you wanted a little bit more theta, a little bit more delta. There's a lot of choices in there on the XHB, or the individual play on Lennar, built out as a bull call spread, a little strength in that sector from a recent price performance perspective. Matt, what do you think here? Which one would you prefer?
I like them both. I think they're both well-structured trades, well thought out. The analysis is pretty spot on. I really like Lennar's strength right now against what the home builders are doing. It's trading very similar to the home builders. It's just front running the home builders a little bit. And when you break down all the home builders, you got a couple stocks that are approaching the highs, but they're overextended and they don't have good technical triggers today. The rest of them are underperforming the actual sector itself. And so you're talking about one of the bigger dogs out there, one of the better stocks in this space in Lennar as well. I like the Lennar pick. And typically when I'm sixes on a theta versus delta, I'm a delta guy. So I'm gonna lean towards the delta side of it.